Okay. Good morning, everyone. Good morning, Shruti. Good morning, Tanisha. Good morning. It's been a long time since we last met, and you people have become experts in your Ind AS. Yes, I presume most of the syllabus would have been completed by now. So just the last few topics are left that deals with uh, 101. Today we are doing revenue and then analysis of financial statements. So I presume that it takes care of your entire syllabus. Yeah, Shankar, good morning. Good to see you after so long. Yes, though I'm not seeing you in reality, but yes. All right. So we had a request that we could not solve adequate problems in Ind AS 115, which I was also aware of. So there was this pending requirement that we continue to meet, that we continue to have some uh, uh, problem solving session on Ind AS 115. So today is finally that day where I will be taking you through some of the questions that we may have not solved, and we will solve that. And I'll try to run you through some of the RTP and examination questions. So you know you're kind of prepared for the questions that could come forward. Okay. So you have done the big standards, business combination, financial instruments, and all the other standards are done. 115 was done way back somewhere, I suppose, in September. Yes. So I hope that memories are partly, they are not totally dimmed out as far as 115 is concerned. But I will just take a quick back, or what you can say, a quick revisit of the entire chapter so that you kind of refresh what we have, get refreshed about what we have already done. So the main thing what we started up when we did Ind AS 115 was that this is a revenue standard with a difference. This is a revenue standard where there is a big difference in the way we are going to recognize the revenue. Sir, why is there a difference? Well, the difference primarily arises because we are now recognizing revenue based on satisfaction of performance obligations and not on mere transfer of risk and rewards. So that is the fundamental area of change. Okay. So we follow something known as a five-step model. The five-step model is the bedrock of Ind AS 115. The step number one being identify your contract with the customers. Second one is identifying the performance obligations in the contract. The third one being determination of the transaction price. Fourth one is allocating the transaction price to each of the performance obligations. And last step being recognize revenue as and when the performance obligations are discharged. So these are our broad five steps that we have discussed in detail in the earlier sessions that we had. So when we talk about identification of contract, I do not have much to explain. It's largely theoretical. Yes. The important part about identification of contract is basically the fact that you have to know what is distinct goods and or services. What is distinct goods and or services? Goods or services which are distinct in the context of the contract. Goods or services which are distinct in the context of the contract. So that is something which we have already discussed in detail. Okay. So I again will not revisit much of that. I hope those concepts are clear to all of you. Yes, if there is anything, please feel free to ask. If there is anything, please feel free to ask. So then we can just touch upon that in brief. Are you guys wanting that, or should I proceed further? Hmm? Are you guys wanting distinct good services, or should we proceed further? Yeah, come on, tell me. Yes. Okay, fine. So when we talk about goods distinct obligations, that is essentially distinct goods or services in the context of the contract, the standard gives you very clear guidance. Okay, the standard gives you very clear guidance. The standard tells us that customers should get benefits from those goods and services which are delivered under each such performance obligation, and each performance obligation should be separately identified. So when I say distinct obligations, I'll just quickly run you through it. When I say distinct obligations, basically transfer of goods or rendering of services. Basically, it is transfer of goods or rendering of services. So therefore, okay. So now, what does the standard require? What does the standard require? The standard requires that customer should get benefits from goods or services from each such obligation. Okay. And and each performance obligation should be separately identified. Should be separately identified. So when I say that each performance obligation should be separately identified, what do I mean? What do I mean? So the standard gives you three scenarios or three cumulative conditions which you have to fulfill. The first condition, and you would be aware of this, you would have heard of this. At the moment, it may have slipped your memories, but I'm sure you will recollect when I do. The first one is such goods and services should not be part of a single integration activity. What does it mean? For example, you are a construction infrastructure developer. You are constructing a dam. As part of construction of the dam, you are providing engineering services, procurement services, construction services. These are known as your EPC contracts. So you are effectively providing three different services. You are engineering, that means you are drawing, designing, looking at how best the dam can be standing for many years to come, what kind of material should be used, how should you construct the dam so that it can be of maximum benefit, how should you construct the reservoir behind the dam. So these are all your engineering services. Next one, to do this activity you have to procure material. You will need tons of steels, bricks, stones, cement, etc, etc, etc. So you are providing an engineering service, you are providing a procurement service, and finally with the engineering diagrams, the procured material, you are going to construct. So EPC contract. So you are providing three different services. But the point is, are they really distinct? Answer is no. They are very much integrated with each other. They are very much integrated, and therefore we cannot call them as distinct goods and services in the context of the contract. All three of them together are part of a single integration activity, and therefore they are not distinct goods or services. Second one, these are cumulative conditions. And should not be customization or modification. Okay. For example, updates to Android. or iOS. Okay, or even your Windows, whatever it is. So when you get these updates, they are mere modifications in the nature of an update. They are mere modification or customization in the nature of an update. That's right, Shankar. And last one is should not be highly interrelated. Should not be highly interrelated. That's it. So when I say highly interrelated, you are traveling from, let us suppose, Delhi to Kolkata by flight. So the flight includes, number one, transporting you as a person from Delhi to Kolkata. That is the first thing. Second thing, transporting your baggage in the hold of the aircraft from Delhi to Kolkata. So this is the handling charges, baggage handling charges. So two services are being provided, moving you from Delhi to Calcutta. And the next one is transporting your baggage. That means collecting it, putting on the conveyor belt and making it undergo that X-ray scanner and then moving it into the hold of the aircraft, and from the aircraft unloading it and putting it on the conveyor belt at Kolkata. So all these are the various services which form part of which come under the broad umbrella of luggage handling services or baggage handling services. So two services are being provided. But are they really two different services? Answer is no. They are highly interrelated services. Okay. Although we now do have a concept of unbundling of services, so if they are unbundled, then definitely they will be distinct services in the context of the contract. Because you do have certain cases where there is a light fare where you can only take baggage along with you onto the cabin, number one. And that's it. They will not handle the baggage for you. If you want them to handle the baggage for you, you have to pay something extra. So they are treating it as a distinct service. You are treating it as a distinct service. Okay, so that takes care of your distinct obligations or goods or services. What is the meaning of that? Okay, so this was an important concept we saw when we were doing the first point, that is identification of contract with the customers. Okay, should not be customization or modification. There is no question of significant modification or customization. Okay, what do you mean by significant modification? Significant modification probably means you're altering the nature of the goods only altogether or the services which you are performing. Okay, so you cannot really say it could be very significant. It could be mere significant, it could be mere small modifications here and there, which will, which will be categorized under this. All right, so that takes care of distinct goods and or services. So this is important when we did the first part, that is identification of contracts with the customers, followed by we saw combination of contracts for which we needed to know distinct goods and or services. And last one, what we saw was contract tenure or contract term, whatever it is. So these were the small things which we discussed. Nothing much from a problem solving perspective. Let me move further. Identification of performance obligations in the contract. So in the identification of performance obligation, this was in fact step number 2. This was in fact step number 2. But why did we discuss this? We had discussed this to understand combination of contracts specified under step number 1. So that is why we saw this. Then in step number 2, we also saw certain special points like principal versus agency relationship. A principal, who is a principal, who is an agent, what is the revenue that they recognize? The principal is the one who will actually recognize the revenue of arising on the contract, whereas the agent is only going to recognize your the commission that is due on such sale. He has no control over the goods and or services. Okay, we saw the example of companies like Make My Trip or Go IB Go, etc., where they do accept the bookings on behalf of the aircraft. But is the aircraft revenue their revenue? Answer is no. They are getting some commission from the aircraft. That is their revenue. The entire revenue actually belongs to the airline. So that was your principal versus agent. And then we saw upfront non-refundable fees. Okay, so you have these airlines coming out with these saver fares, right? They come out with offers or they come out with saver fares where they're ultra low, but the hitch is they are non-refundable. They are non-refundable. So entity is under. So when do you recognize the revenue? When do you recognize the revenue, sir? Do you recognize it on immediate receipt of the funds, or do you recognize it at a subsequent date when the obligations are fulfilled? What do you think? Non-refundable fees. When should you recognize? On receipt or on completion of the performance obligation? Not either. Not either. It is one of the two. Okay, Dheeraj? Not on receipt. Look at the five-step model. Five-step model is the fifth step is recognize revenue as and when performance obligations are fulfilled. Sir, but ये तो non-refundable fees है. I know where this comes from. You are saying this is a non-refundable fee. So therefore, I have to recognize it immediately, is what you would probably be thinking. But don't think like that. That is not right. Because two things have to happen. Either you perform the obligation, number one, or an event that prevents you to perform the obligation has happened, which will require you to recognize the revenue. So suppose I book an airfare, I book an air ticket for traveling on 31st of May. For traveling on 31st of May. The cost of this ticket is 3,000 non-refundable. So today I booked this ticket. So I have booked the ticket on 18th Feb. So this is the date I have booked the ticket. And when I book this ticket, I pay the money to Indigo. Indigo will recognize this only as a deposit. Only as a deposit. But sir, it is non-refundable. Hey, I'm not denying it. But right now, you have an obligation to deliver. Right now, you have an obligation to deliver. But I deliver or don't deliver, पैसे तो मुझे return नहीं करने. I don't have to refund the money back. Agreed. You don't have to refund the money back. I don't deny that. But the standard is very clear when it says performance obligation must be fulfilled. So on 31st May, when I undertake that flight, that point of time, this advance will be moved to the revenue. Or an event must happen which will not allow me to perform the obligation. In simple layman terms, I do not go and board the flight. So therefore, now there is no question of having any pending obligation because the flight has taken off and I have not been able to reach the airport, or I have not been able to, I have not been able to board the flight. And therefore, the transaction is cancelled, the fare is non-refundable, and I will then recognize the revenue. Okay. So are you kind of able to recollect what all we have done? Yes. Okay. So this is distinct goods. Then we saw the next step, that is identification of performance obligations. Step number 3 is transaction price. Step number 3 is transaction price. Very, very important. It comprises of two things. One is your fixed consideration and the other is your variable consideration. Fixed consideration always goes and sits as a part of your revenue. Variable consideration could be further categorized into two parts. One is variable constraints, variable consideration subjected to constraints, or variable consideration not subjected to constraint. If you remember, I had given an example of L&T Infra constructing a bridge or a toll road where there is a bonus for every month, saved in delivering the contract, for every month saved in delivering the contract. So earlier, how I used to do? Earlier, I used to recognize the incentive or the bonus when it actually came to me, that is on receipt basis. But here 115 says, don't do that. You estimate the bonus that you are going to get, include it in your transaction price, and then do the working. So this moves from a conservative system to a more realistic basis of accounting. I think you should be able to recollect this. Okay. Now, uh, sir, but variable consideration is variable, na? Matlab, I may not get it. That is why they say variable consideration not subjected to constraints only, you will do this. If variable consideration is subjected to constraints, then you are not going to recognize this as a revenue. You are not going to recognize this as a revenue. Okay, so that takes care of your variable consideration. Then we saw warranties, warranties in the nature of assurance warranties or warranties where you have specifically purchased. So how do you recognize the revenue? You have seen that. Okay. Assurance warranties, no separate provision is required. Um, Yeah, so basically you have two warranties. One is option to purchase a warranty separately, and second is there is no option to purchase the warranty separately. These are assurance warranties where you are not going to purchase it separately. So you will take it as a part of the transaction cost. There is no standalone warranty price which is available, and you will recognize a provision in line with Ind AS 37. But if it is an assurance type warranty, it is a distinct service. So many times you go to buy a phone, they will say, sir, extended warranty le lo for accidental damages, this damage, that damage, etc. And then they will send you with another 2000 rupees into their pocket. You have purchased an additional warranty. You have purchased an additional warranty. It is nothing but a distinct goods or service, a distinct service that that is being provided to you. Okay. So that is your warranty. You will recognize the revenue as and when you satisfy the performance obligation. So this was the point which we had discussed. Coming to the next one, in your transaction price itself, we have something known as significant financing component. That is where you give extended credit periods to your customers more than the normal. So the standard says in such a scenario, there is a strong possibility that you are having a financing arrangement. And now you guys have studied Ind AS 109. Am I right? Yes, you guys have studied Ind AS 109. Am I right? Yes. Bolo. Yes. So under Ind AS 109, you basically do a discounting and then you record it. Okay. And then you record a financial liability along with the interest accruing thereon. Basically, for liabilities, you follow what is known as an amortization concept. Okay, so you have FVTPL, FVOCI, etc., etc. So if you see those business model test and all, there is an amortized cost model that is being followed. So same model is what is going to be followed here. Okay. So I think I had run you through some of the questions on financing, but let me take a quick look. Yes, if anything is pending for us to do. I'm just referring your study module. I'm not doing anything else. Then we'll pick up the RTPs, etc. Okay. Alright. So this question determining the discount rate is what we have already done. You can just confirm once. Okay. Illustration 39 is what we have already done. We'll just quickly run through illustration 40. We'll quickly run through illustration 40. Okay. Yeah. ST Limited enters into a contract with a customer to sell an asset. Okay. ST Limited is selling the asset to a customer. Control will be transferred to the customer in 2 years. That is performance obligation satisfied at a point in time. The contract includes two alternative payment options. First one, payment of 5,000 in 2 years when the customer obtains control of the asset. And second one is payment of 4,000 when the contract is signed. So it is either pay 5,000 after 2 years or pay 4,000 immediately, and then you will get your asset at the end of 2 years. Okay. ST Unit concludes that the contract contains a significant financing component because of the length of time between when the customer pays for the asset and when the entity transfers the asset to the customer, as well as the prevailing interest rates in the market. Okay. Interest rates are implicit at 11.8%, which is the interest rate necessary to make the two alternative payment options economically equivalent. However, the entity determines that the rate that should be used in adjusting promised consideration is 6%, which is the entity's incremental borrowing rate. Past journal entries showing how the entity would account for the significant financing component. Is it okay? Go through this question once. Go through this question. Yes. Okay. Do you agree that there is a significant financing component? Do you agree that there is a significant financing component? Yes. Okay. See how the case looks like. First April 22, 31st March 24. So there are two options that is being given to the customer. Pay 4,000 and take the delivery of your product after 2 years. Or after 2 years, pay 5,000. After 2 years, pay 5,000. So this is the arrangement. Okay, pay this or pay 5,000 after 2 years. Now the question is, if I pay today, I'm getting a discount. If I pay after 2 years, I have to pay 5,000. You tell me, is there a significant financing component in this arrangement or not? है तो now there is a significant financing component. If I pay 4,000 today, I am getting a discount of 1,000. Sir, why are you getting a discount of 1,000? Sir, I am getting a discount of 1,000 because I have paid 2 years prior to purchase. I have paid 2 years prior to purchase, and therefore, you are going to say that there is a significant financing component in this 4,000. There is a significant financing component that is there. Okay, very clear. Well, discount is just a name, but it is nothing but a financing component. Now the question is, sir, which what you can say? Okay, which rate of interest should you use? Which rate of interest should you use? Okay, let us look at the question. The interest rate implicit in the transaction is 11.8%. So 1st April 22, I pay 4,000. 31st March 23, the interest at 11.8% would be 472. So 4472. 31st March 24. 4472 into 0.118. 528. So this comes to 5,000. This comes to 5,000. Okay. Now, this is your implicit interest rate. But does the standard give you the option to go for implicit interest rate? Answer is no. The standard says go for incremental borrowing rate. The standard says go for incremental borrowing rate, that is 6%. The entity determines that the rate that should be used in adjusting the promised consideration is 6%, which is the entity's incremental borrowing rate. Yes. So therefore, 4,000 plus 6%. So that comes to, I think, 240. Yes. 4,000 into 0.06, 240, and into 0.06. That is 254. So 4240. 4,494. 4,494. Okay. So now, what are you going to do? Sir, I will follow 6% IBC. Okay. All right. Incremental borrowing rate, sorry, IBR. This is the rate that you will follow. Don't look at this rate. Don't look at this rate. This is not an entity specific rate. This is not an entity specific rate. Okay? So you are not going to consider this. You are not going to consider this. But sir, 4,000 आज है, 2 साल बाद 5,000 है. That is the seller's rate. That is the seller's rate. Okay. For you, the incremental borrowing rate is 6%. And you will do it at the incremental borrowing rate. You will do it at the incremental borrowing rate. Are you okay? Have you understood this? Have you understood this? Yes. Any doubts? Do not take 11.8%. Okay. That is a mere equalization that is happening. 4,000 becoming 5,000 is a mere equalization. But you, that is the seller, your incremental borrowing rate is 6%. You will stick to 6%. You will stick to 6%. Are we clear? Yes. So what am I going to pass the entry? First entry, when you get the money, bank account debit to contract liability. You cannot book the revenue since revenue will be booked only after 2 years. Okay. So bank account debit to contract liability. Then end of year one, finance cost account debit to contract liability 240. Then third entry will be same finance cost account debit to contract liability 254. And finally, contract liability debit to revenue 4,494. 4,494. What will happen to the difference? So now I was expecting this question. So I got that question. Sir, 5,000 is the selling price. 4,494 is what you have recognized. So therefore, the question is, what will happen to this balance 506 rupees? You only tell me, Shruti, is this 506 appearing anywhere in the books? Is this 506 appearing anywhere in the books? Yes. No, absolutely right. 506 is not appearing anywhere in the books. And therefore, will you consider that? Answer is no. You will not consider that 506. Just ignore it. Just ignore it. You will do the incremental borrowing rate working only if it is given. If that is not given, then at that point of time, you will go to the implicit rate of interest. You will go from the implicit rate of interest. Is it okay? Yes. So that takes care of this question also. Illustration 40. Anybody has any doubts so far? Anybody, any doubts? Sir, what if the customer opts for payment of 5,000 after 2 years? What if the customer opts for payment of 5,000 after 2 years? Then this will be again, has he paid you anything at the inception of the contract? Let me tell you where you guys are getting confused. You are looking at 4,000 and 5,000 together. You are looking at 4,000 and 5,000 together. Do not look at it together. आप दोनों साथ में देखोगे, you are going to fall in trouble. Look at it as mutually exclusive. मतलब क्या है? If a customer pays 4,000, he will not pay 5,000. So you will have only 4,000 sitting in front of you. If a customer pays 5,000, he will not pay 4,000. That is the way you will have to think and do the workings accordingly. Okay. That is the way you will have to look and think about it. When you look at our thought processes, acha, 2 saal baad 4,000 is becoming 5,000. That is wrong. That is not right. That is not the way to think. If you think 4,000 becomes 5,000 after a period of 2 years, then that thought process is exactly not matching with the guidance that is there in the standard. If you are giving a customer an option to pay today and he pays it, you are giving it 4,000 rupees. But the same customer, if he says, I will pay you after 2 years, I will pay you after 2 years, then you are moving towards a realization at the end of 2 years itself. You are moving towards a realization at the end of the second year. And revenue also will be realized at that point of time. Revenue also will be recognized at that point of time, because at that point of time only you are what you can say, you are fulfilling your performance obligation. Don't think of it as a forward moving transaction. Think at it as a backward moving transaction. क्या मतलब है इसका? See, let us take it for example something like this. After 2 years, selling price is 5,000. But if you pay now, selling price is 4,000. So kind of saying this is a discount of 1,000, which is a finance charge. But don't take implicit rate of interest because your incremental borrowing rate is there. So if you opt for now, you cannot take this. If you opt for this, you cannot take this. Okay, very simple. Okay. So don't think दोनों साथ में चल सकते हैं, दोनों साथ में नहीं चलेंगे. It's one of the two. Okay, all right, fine, done. So that takes care of the question. That takes care of the question. Okay, fine. Next one. Is it clear, everyone? Yeah. Yes, it is treated as a finance component. That's right. All right. Coming to the next one, illustration 41. Theoretical है, we can quickly run through it. Okay. ABC enters into a contract for construction of a power plant that includes scheduled milestone payments. Include scheduled milestone payments for the performance by ABC Limited throughout the contract term of 3 years. The performance obligations will be satisfied over time. Milestone payments are scheduled to coincide. Milestone payments scheduled to coincide with the expected performance by ABC Limited. The contract provides that a specified percentage of each milestone payment is to be withheld as a retention money by the customer throughout the arrangement and paid to the entity only when the building is complete. Analyze whether the contract contains any financing component. Bolo, read it and say, is there a financing component here? Read the question. There is a retention money that is there, which will be paid after some time. So will you say there is a financing component or there is no financing component? Do you know what is retention money? No finance component. That's right. Retention money is merely protective in nature. You are protecting your position as a customer because these are long-term contracts or construction contracts where even if one part is not done properly, it could create problems for the entire structure. And therefore, to ensure the vendor comes and does any repairs, you are doing a what you can say, a retention money withhold. So that is not going to be a significant financing component. Illustration 41 is done. Okay, next, next. Okay, read illustration 42. XYZ Limited, a PC manufacturer, enters into a contract with a customer to provide global PC support, repair coverage for 3 years, along with the personal computer. Along with the personal computer. The customer purchases this support service at the time of buying the contract, of buying the product. Consideration for the service is an additional 3,000. Customers elected to buy this service must pay for it upfront. That is, a monthly payment option is not available. Whether there is any significant financing component in this contract or not. Yes. Is there a financing component or not? And why? Yeah. There is no significant financing component because you only have option to pay in advance. You only have option to pay in advance. There is no option of paying on a monthly basis, and therefore there is no significant financing component. There is no significant financing component. Are you okay? Yes. Have you understood the reasoning? Yeah. Don't say that it is payment only for support service, etc., etc. Understand the transaction. Am I giving an option for delayed payment to other customers? Answer is no. It is very clear. Consideration for the service is an additional 3,000 and they must pay for it upfront. They must pay for it upfront. That is, monthly payment option is not available. That means whether it is X, Y, Z, Shruti, whoever it is, Tanisha, Mansha, whoever, Dheeraj, you all have to pay it in advance. There is no option for a monthly payment. There is no option for a monthly payment. And therefore, you are going to not have any financing component in this. You are not going to have any financing component in this. Are we okay? Yes. Okay. All right. Fine. Okay, so go through this one question. I leave you for homework. Chota sa hai. Okay. We shall proceed to the next one. A software vendor enters into a contract with a customer to provide license solely in exchange of a sales-based royalty. Analyze whether there is any significant financing component in the contract or not. Yes. Next. Please check sales-based royalty. Yeah. Quick, quick. No, there is no financing component. Why? Because the consideration for this is entirely variable, which is not within the control of the entity, and therefore, this is variable. This is variable. I cannot determine the value today because I am not aware of the sales I will achieve, and therefore, your transaction cannot be said to have a financing arrangement. It cannot be said to have a financing arrangement. Are we okay with this? Yes. Yeah. Done. Okay, so I want you to go through these questions for homework. Okay, Baki to this insignificant financing component, whatever numericals were there, we have already solved. Okay, done. Okay, coming next. Right. Just checking which order can I proceed so that it makes sense to you. Consideration payable. Okay, fine. This would be non-cash consideration. Okay, yeah, fine. Now we are again in the third step only, that is your transaction price. Significant financing component is done. Now coming to the next one, that is non-cash consideration. Non-cash consideration, that is basically your barter. Okay. So when I say non-cash consideration, how am I going to recognize the revenue? How am I going to recognize the revenue? So a non-cash consideration should a transaction having a non-cash consideration should have a commercial substance. What do you mean by commercial substance? Basically, the cash flows before and the cash flows after the transaction should be different. The cash flows should be different. Risk and reward should be different. Only then we can say that it has a commercial substance. Okay, so that is the first point. Now, when I say a non-cash consideration, then you have to recognize it on the basis of fair value of consideration received. Fair value of consideration received. If this is not available, then the standalone price of the goods or services given up. Okay. So for non-cash, we had done this. I'm just repeating. For non-cash consideration, fair value of goods or services received, fair value of goods or services received, number one. Second is, or if this is not available, then standalone selling price of goods, services given up. Goods or services given up. Is it okay? Yes. Whichever is evident. Whichever is more clearly reliable. These words are not there in the standard. These words are not there in the standard. You will remember Ind AS 16, property, plant and equipment. Ind AS 38, intangible assets. Ind AS 40, investment property. In sub mein, when you recognize the revenue, when you recognize the asset, when you pay other than cash, what the standard says, fair value of the incoming asset or consideration given, whichever is more clearly reliable or whichever is more clearly evident. Ind AS 115 does not say this. Ind AS 115 is very clear. You are selling something because you are expecting something in return. So for you, the revenue will be the fair value of what is coming in, because that is what you had expected in the first place. Otherwise, you will not do any revenue transaction. So therefore, the first preference will be fair value of goods or services received. If that is not there, then you move on to standalone selling price of goods or services given up. Goods or services given up. Are we clear with this? Yes, are we clear with this? So with this background, let us go to this one question. MS Limited is a manufacturer of cars. It has a supplier of steering systems, SK Limited. MS places an order of 10,000 steering systems on SK Limited. It also agrees to pay 25,000 per steering system and contributes tooling to be used in SK's production process. The tooling has a fair value of 2 crores at contract inception. SK determines that each steering system represents a single performance obligation and that the control of the steering system transfers to MS upon delivery. SK may use the tooling for other projects and determines that it obtains control of the tooling. Determine the transaction price. Determine the transaction price. Okay. So now, what is happening? MS, SK. MS manufactures cars, SK manufactures steering systems. So, MS places an order of 10,000 steering systems. 10,000 steering systems. Value is 25 crores. Value is 25 crores. 10,000 into 25,000. It also agrees to pay 25,000 per steering system and contributes tooling to be used in SK's production process. So, in return, MS is also giving tooling worth 2 crores. Tooling worth 2 crores. So what is your consideration? Very simple. मैं 25 करोड़ steering का दे रहा हूँ. 2 crores I am giving of the tooling. 2 crores I am giving of the tooling. And therefore 25 plus 2, 27 crores. This is your transaction price. This is your transaction price. Are we okay with this? All right. Okay, great. So then let us proceed further. Consideration payable to the customer. I think we had discussed this also. This is what we have discussed now. Non-cash we saw. Let me see, where is that? Okay. I may have given it separately. Okay. Acha. Consideration payable to the customer. Acha. Is there anything wrong in this statement? What is different about this statement? Consideration payable to a customer. What is different about this particular heading? Are normally consideration is payable to a vendor. Consideration is payable to a vendor. It is never payable to the customer. Okay. So you recollect, have we done this? Yes, you recollect this. Consideration payable to a customer. Okay. Normal transaction, seller, customer. Seller sells goods or services and customer does the consideration paid. Consideration paid happens here. This is the normal transaction. This is the normal transaction. But there is one more transaction which is happening between the seller and the customer, where the customer sells goods or services to the seller, and consideration paid. Consideration paid to the customer. Okay. Now, the question is, the question is, seller is selling the goods to the customer, and from the same customer, the seller is also buying. The seller is also buying. Okay. So now there are two things. Suppose this is 100 and this is 70. This is 70. So seller is selling goods at 100 and buying goods at 70. So therefore, what am I going to do? Yes, what am I going to do? Should my revenue be 100 or should it be 30? Should it be 30? What do you guys think? Should it be 100 or should it be 100 minus 70 equals 30? Yes? क्या होना है? यस, क्या करें? रेवेन्यू कितना रिकॉग्नाइज होगा? 100 और 100 माइनस 70 इक्वल्स 30. बोलो बोलो. See, let me again give you an example. Okay, suppose you are, I think I had given this earlier, but you can just have a look. Suppose you are Cadbury's, okay, and there is a retail store. There is a retail store. Cadbury says, look, I will sell my chocolates to you. Okay, so that selling price is, let us say, 8,000 rupees. Okay, now, so the retailer will pay consideration. Now, Cadbury says, look, boss, at each billing counter, I will need small shelves where Cadburys are stocked. Okay. So billing counter pe customer kya karega? Customer will get bored of waiting. So he will look at the items placed near the billing counter and quickly he will go and put it in the shopping bag. The entire area near the billing space should be earmarked for Cadbury products only. Should be earmarked for Cadbury products only. Are we clear with this? Yes. Are we clear? Yes or no? So therefore, what the retail store is offering Cadbury's is a distinct service that is being offered, is a distinct obligation that is being performed by the retailer in favor of Cadbury. Sir, क्या कर रहा है वो? He is keeping the spaces available for Cadbury. He is keeping those spaces available for Cadbury, and therefore, it is a distinct goods or services. It is a distinct goods or service, and therefore, you will have to recognize the revenue at gross levels and not at net levels. You will have to recognize at gross levels and not net levels. Are we okay with this? Yes. You will do it at gross and not at net level. Why? Because what you are getting from the customer is distinct. What you are getting from the customer is distinct. Are we okay? Yes. Okay. Why did this provision come into existence? Why did this provision come into existence? This provision came into existence because what entities would do is X would sell to Y would then sell to X. Okay. Okay. Now, what will happen is if this provision had not come, X sale to Y would happen at gross, purchases would happen at gross, there would be no knocking off, and therefore, your what you can say, your tendency would be recognize revenue at gross end. Yes, recognize at gross value, not net off. Do not net off. So what you are going to do is you will be having the tendency of doing a gross recognition of revenue without any commercial substance probably or without any justification. So you sell the goods, then Y will sell you back. Again you sell, he will sell back. So basically what is happening is you are inflating your revenues. You are inflating your revenues. And because you are inflating your revenue, the standard setters felt there must be some guidance on this. So this says that it is restricted to, it is restricted to the gross recognition of revenue can be done if and only if what the customer provides is distinct. What the customer provides to the seller is distinct. If that service or goods are distinct, you can go for a gross recognition of revenue. If it is not distinct, you will have to mandatorily do it at net. You will have to mandatorily do it at net. Are we okay with this? Yes. Are we okay? Anybody has any doubts? Yeah. We basically want to avoid inflations of revenue. So therefore, if the goods or services being provided are not distinct, please do not gross up the revenues, net it off and recognize the revenue. If Cadbury recognizes revenue to the retail and retail gives a distinct service in the form of shelves, dedicated shelves, priority placements, putting up of banners, etc., then the customer is doing something for the seller. You will recognize revenue at gross for both. You will recognize it at gross for both. Are we okay with this? Yes, I think it's fairly clear. Repeated a lot of times. Okay. Fair enough. Okay, just look at this. There is a small mistake in this. Okay. A producer entity sells energy drinks to a retailer, that is a convenience store. Producer also pays retailer a fee to ensure that its products receive prominent placement on store shelves to attract the customer's eyeballs. Wow, what language! To attract the customer's eyeballs so that the chances of sales of its products are higher. So basically, eyeballs get attracted and people will start buying. That is what it is saying. The fee is negotiated as part of the contract for sale of the energy drinks. Now, don't read this. Don't read the next part. Okay? इसको अभी मत पढ़ो. Okay? Now you tell me, is there a distinct service that is provided by the retailer to the producer? Is there a distinct service that is being provided by the retailer to the producer? Yes. Is there a distinct service that is being provided by the retailer to the producer? Yes, there is a distinct service provided by the retailer to the supplier. What is the distinct service? Prominent shelves, then chances of sales are higher. He ensures product placement accordingly, etc., etc. So therefore, if these are distinct, should you show the revenues at gross or should you net it off? Should you net it off? What do you think? Should you gross or should you net off the revenue and present it as a single figure? What do you think? Bolo, Tanisha, Shruti, Mohammed, Shankar, tell me, what will you do? Will you recognize it at a gross or will you net off and show the balance? Yes? Yes? You will not net off. That's what I'm saying. If what the retailer provides to the customer, what the retailer provides to the seller, if it is distinct, you will not net off, you will gross the revenues. You will show the revenues at gross. You will show the revenues at gross. Are we okay with this? Yes. So in this case, you are having a distinct obligation that is being provided. So therefore, you will gross it up. You will gross it up. Do not reduce. But look at the institute's answer. In this case, producer should reduce the transaction price by the amount of slotting fees paid to the retailer. Okay. So this part, in my humble opinion, is not right. Is not right. Done? Understood? Okay, fine. So that takes care of that example. So in my humble opinion, this is not right. It has to be at gross. You cannot reduce the transaction price because these services are distinct. Next. An entity that manufactures consumer goods enters into a 1-year contract to sell goods to a customer that is a large global chain of retail stores. Entity commits to buy at least 15 crore of products during the year. The contract also requires the entity to make a non-refundable payment of 1.5 crore to the customer at the inception of the contract. 1.5 crore payment will compensate the customer for challenges, if any, needs to make its shelving to accommodate the entity's products. Entity does not obtain control of any right to the customer shelf. Determine the transaction price. Okay. See, entity customer commits to buy at least 15 crore of products, make a payment of 1.5 crores, will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. Okay. Entity does not obtain control of any rights to the customer shelves. You tell me, is there a distinct obligation that is being fulfilled by the customer to the seller? Is there any distinct obligation? Is there any distinct obligation? Bolo, is there any distinct obligation? No. And therefore, the revenue will be 15 minus 1.5, 13.5. 13.5. Okay. So revenue will be at 13.5. Yes. So that takes care of illustration 52. Understand the reason for a particular treatment, and then you will not have to buy hard. Okay. You can go through this for homework. Yes. All right. Coming to the next one, allocating the transaction price to performance obligations. And finally, revenue recognition. Okay, finally, revenue recognition. Okay, are we able to recollect what all we have done so far? Yes. Is there a lot of disconnect, or are you able to join the dots between what we have discussed and what we are doing today? I want today's session to be maximum efficient for you. I don't mind going even half an hour to 1 hour extra, but I want the commitment from you that it is helpful. Yes. Are you able to join the dots, or you are feeling disconnected? Yeah, because last time it was a little, when we did it, we could not do the questions to do the fullest extent possible. So that is the reason I thought maybe it's required. So are you comfortable? Yeah. I hope you guys are all comfortable. Okay? All right. Okay. Now, how will I do the allocation of? Okay, fine. Now, allocation of transaction price. How am I going to allocate? The first preference is on the basis of standalone selling price. On the basis of standalone selling price. If you are not selling it, adopt a market assessment approach. Check whether your competitors are dealing in that, and then you will have to take that and make adjustments. You will have to take that and make your uh, okay. Yes, if you are not supplying separately, take your competitor's price, do some adjustments for margins here and there, etc. And that is going to be your allocation price. Okay. And last one is if even the comparable prices fail, that is the previous method fails, then you will have to, uh, you know, adopt a cost plus approach. You know the cost of your product, you add a markup, and then that will give you your what they say, um, selling price, based on which you can do the allocation. Based on which you can do the allocation. Are we okay with this? Yes. Okay. Where are you guys? Nobody is there. Okay, we'll do one thing. We'll take a 15-minute break. Okay. Because the next two steps, they are a little long. We have some problems also to do. So we take a 15-minute break and then we shall resume. We take a 15-minute break and then we shall resume after 15 minutes. Okay. We'll revisit both the steps, last step number 4 and 5, see the questions and close for the day. Okay. A 15-minute break, please. Welcome back, guys. So coming to allocating the transaction price to the market of to the performance obligations. How do we allocate? Okay, so this also I think we had done in the last session what we discussed. So how exactly do we do the allocations? The first one is on the basis of standalone prices of the entity. If the entity does not deal on a standalone basis, then you will look at the prices in the market. It could be your competitors, etc. We call it as market assessment. And even if this is not available, then we go to the cost plus approach, wherein you look at the cost of each distinct performance obligation and add a reasonable markup. If this method also fails, then you go for the residual method, where if you are providing multiple goods and services, then one of them which does not fulfill any of these three criteria, then you go ahead and take it as a balancing figure. You go ahead and take it as a balancing figure. Are we okay with this? Yes. So this is the manner in which you will allocate the transaction price to each of the performance obligations. Okay. So with this background, let us come and look at some of other questions that are there for this. Yes. Allocation. See, all these methods are there in the study material. Okay, so you could go ahead and have a look at it. Okay. Yeah. Come to illustration 54, allocation methodology. An entity enters into a contract with a customer to sell products A, B, and C in exchange for rupees 10,000. The entity will satisfy the performance obligations for each of the products at different points in time. Entity regularly sells product A separately, and therefore the standalone price of that is directly observable. Standalone prices of B and C are not directly observable. Because they are not directly observable, entity must estimate them. To estimate, the entity uses the adjusted market assessment approach for product B. Market assessment approach means customer price plus certain adjustments, and the expected cost plus a margin approach for product C. In making those estimates, the entity maximizes the use of observable inputs. The entity estimates the standalone price as follows. Product A 5,000 directly observable. Product B 2,500 adjusted market assessment approach. Product C 7,500 expected cost plus a margin approach. Determine the transaction price allocated to each product. Determine the transaction price allocated to each product. Okay. So currently we are having the selling price for all the three together as 10,000 rupees. We are having the selling price of all the three together as 10,000 rupees. Whereas if you look at the question, the total price is 15,000, what they have determined. So you are getting a 5,000 rupees discount because you have done all the three together. You have gone ahead and purchased all the three together. So therefore, you will be regarding this as a discount of 5,000 rupees. The question is, how do I allocate this discount? The question is, how do I allocate this discount? Okay. So now let us come back and try to solve this. Okay. So I have A, B, C. The selling price is 5,000. This is 2,500 and this is 7,000. This is 5,000, 2,500 and 7,000. Now, how do I allocate the discount? Sir, are you given any product is having a higher discount than the others? Answer is no. I do not have such data. and therefore we will allocate the discount in the proportion of the standalone selling price itself. We will allocate the discount in the ratio of standalone selling price. So 5,000 is my discount. I will allocate one third to product A, 5,000 divided by 15,000. 2,500 minus this is allocation of the discount into 2,500 by 15,000, and last one is 5,000 into 7,500 by 15,000. So when you do this, you will get the final selling price as 3,333. This is going to be 1,667, and this is going to be 5,000. So this is the allocation that will be followed. This is the allocation that will be done. This is illustration 54. Are we clear with this? Good morning, Viraj. Good morning. Yes. Are we clear with this? Anybody has any doubts here so far? Okay. Let us move on to the next. Illustration 55. Okay. An entity regularly sells products X, Y, and Z individually, thereby establishing the following standalone selling prices 50, 25, 45 for X, Y, and Z. In addition, the entity regularly sells Y and Z together for 50,000. So there is a specific discount allocation which is given. There is a specific discount allocation which is given on Y and Z together. Case A, the entity enters into a contract to sell products X, Y, and Z in exchange of rupees 1 lakh. Okay. The entity will satisfy the performance obligations at different points in time. Y and Z at the same point in time. Determine the allocation of transaction price to product Y and Z. Okay. Case B, residual approach is appropriate. Okay, we'll look at case B later. First one, illustration 55. Case A. Okay. X plus Y plus Z is being sold for 1 lakh. Therefore, discount is equal to 20,000. Discount is equal to 20,000. How do I get this 20? Well, the standalone prices are 1 lakh 20. Transaction price is 1 lakh. Transaction price is 1 lakh. Is it okay? All right. Now the question is, how should I allocate this discount? Answer me yes or no. Can I allocate 20,000 entirely to X, Y, and Z? Can I allocate 20,000 discount entirely to X, Y, and Z? Proportionately? Can I allocate it on the basis of the standalone prices? Yes. Yes. No. बोलो यार. Can I allocate entire 20,000 on the basis of this standalone price, or is there anything else which you are able to see? Okay, let me proceed. See, Y and Z together are worth 25 plus 45, 70,000 rupees. But they are sold regularly for 50,000. They are sold regularly for 50,000. So, if I talk about Y and Z, Y plus Z. Okay. Now, this total discount of Y plus Z can be done something like this. The selling price is 25,000 plus 45,000, 70,000. Combined selling price is equal to 50,000. Therefore, net discount is equal to 70 minus 50. That is 20,000. So now on the entire transaction, you are getting a discount of how much? Sir, I'm getting a discount of 20,000. But this 20,000 is regularly given only on products Y and Z. It is regularly given only on products Y and Z. So my question to you is, and answer me very thoughtfully. Is this 20,000 discount fair to allocate to X, Y, and Z? Or should it be allocated only to Y and Z? Should it be allocated only to Y and Z? It should be allocated only to Y and Z. It cannot go to X because this is a regular discount which is there only for Y and Z. X would be a premium product for which there would be no discount. So this is like saying that X is a product which is in high demand and people are always willing to buy it at the price point. So therefore, we will allocate the discount only to Y and Z. So Y and Z. The transaction price is 25,000, 45,000 minus the discount is 25, sorry, 20,000 into 25 by 70, and this is 20,000 into 45 by 70. Yes, that's right. So therefore, 20,000 into 25 by 70, 17,857. 32,143. So this total comes to how much? 50,000. Therefore, X will be at 50. Y will be 17,857. Z will be 30 to 143. Total will be 1 lakh. This is how you will do the allocation. This is how you will do the allocation. Are we okay with this? Yes, everyone, any doubts so far? Okay. Now let us proceed to the next part of the question. Case B, the entity enters into a contract to sell X, Y, and Z as described in case A. The contract also includes a promise to transfer product alpha. Total consideration in the contract is 1,30,000. The standalone selling price for alpha is highly variable because entity sells alpha to different customers for a broad range of amounts ranging between 15,000 to 45,000. Determine the standalone selling price of product X, Y, Z, and alpha using the residual approach. Okay, fine. So that is something we will now have to check. So X, Y, Z, and alpha. Total of this is now 1,30,000. Do I have a standalone price attributable to alpha? Do I have a standalone price attributable to alpha? You have just now seen the information. Do you have a standalone price attributable to alpha? Yes. Okay. There is no standalone selling price available for alpha. वो रेंज में है 15,000 to 45,000 कौन से भी रेंज में वो प्राइस आ सकता है. So therefore there is no standalone selling price available for alpha. So what will I do? Well, we will have to follow the residual approach. So last question में we had arrived at these values if you recollect case A. Okay, so case B, let us now take alpha as the balancing figure. Let us take alpha as the balancing figure. इसको हम लोग बोलते हैं residual approach. इसको we call this as residual approach. So coming to this part, it is saying it should be within 15 to 45,000. Is 30,000 within 15 and 45? Answer is yes. So therefore, this could be one of your allocations. This could be one of the allocations. Are we okay with this? Yes. Yes. Anybody has any doubts so far? Yes. Is it okay? 30,000? Yes, it falls between 15 and 45. So it is okay. All right. Coming to the next case C. The same facts as in case B apply to case C, except that the transaction price is 1,05,000 instead of 1,30,000. So alpha anyways does not have its own standalone selling price because of the variability. So 50,000, 17,857, 32,143, 1,05,000. So this gives me 5,000. This gives me 5,000. Tell me, is 5,000 acceptable or not acceptable? Is 5,000 acceptable or not acceptable? Yes, is 5,000 acceptable? Not acceptable because it does not fall within the regular selling price of 15 to 45,000. So there has to be another basis for doing this allocation. Wo basis is not given in the question. I cannot calculate that. And therefore, you will have to just mention in your answer that it is not acceptable because it does not fall within the range. And therefore, alternative methods has to be given for which information is required जो उन्होंने दिया नहीं है. They have not given the information. Are we okay with this? Yes. $5,000 would not faithfully depict the amount of consideration to which entity expects to be entitled. Okay. So the entity allocates the transaction price using the relative standalone selling prices of those products. Okay? ठीक है, सही है. That's right, Satish. Good, Satish. Good, Shruti. Okay? So that takes care of illustration number 55. Illustration number 55. Okay. Coming next, illustration 57. Okay. On 1st April X0, a consultant enters into an arrangement to provide due diligence, valuation, and software implementation services to a customer for 2 crore. The consultant can earn 20 lakh bonus rupees if it completes the software implementation by 30th September X0, or a 10 lakh bonus if it completes the software implementation by 31st December 20 X0. The due diligence, valuation, and software implementation services are distinct and therefore are accounted for as separate performance obligations. The consultant allocates the transaction fees disregarding the potential bonus on a relative standalone selling price basis as follows. So, due diligence 80 lakhs, valuation 20 lakhs, software implementation 1 crore. At contract inception, consultant believes that it will complete software implementation by 30th January 20X1. After considering the factors in Ind AS 115, the consultant cannot conclude that a significant reversal in the cumulative amount of revenue recognized would not occur when that uncertainty is resolved since the consultant lacks experience in completing similar project. As a result, the consultant does not include the amount of early completion bonus in its estimated transaction price paid at contract inception. On 1st July X0, consultant notes that the project has progressed better than expected and believes that implementation will be completed by 30th September X0 based on a revised forecast. As a result, the consultant updates its estimated transaction price to reflect a bonus of rupees 20 lakhs. To reflect a bonus of rupees 20. After reviewing its progress, yes, the consultant determines that it is 100% complete in satisfying its performance obligations for due diligence and valuation, and 60% complete in satisfying its performance obligation for software implementation. Determine the transaction price. Okay. Yes. Read the question once again, please. Read the question quickly. Yes. What is happening here? See, basically, I'm having two services or two performance obligations at standalone selling prices. Okay. But software implementation, which is there, that is a variable consideration. That is subjected to a variable consideration. Okay. So, therefore, you will have to factor the variable consideration only for the software implementation and not for the others. As far as 1st July X0 is concerned, due diligence is 100% complete. Software implementation is 60% complete. Software is 60% completed. Are we okay with this? Yes. Even the valuation, due diligence valuation, both are 100% completed. So determine the transaction price. Determine the transaction price. Okay. So revenue recognition. Okay. So here I am having $80 lakhs entirely complete. So 80 lakhs. Next is 20 lakhs. This is also entirely complete. So 20 lakhs. And coming to software implementation. Yes. Is there a variable consideration? Yes or no, and in what form? Yes. See, software implementation, the base price starts at 1 crore. The base price starts at 1 crore. But you are having a 20 lakh bonus if it completes by 30th September, 10 lakh if it completes by 31st December. Okay. So now, as on 1st July 20x0, the consultant updates its estimated transaction price to reflect a bonus of 20 lakhs. To reflect a bonus of 20 lakhs. Are we okay? Yes? Yes. So therefore, 1st July 20x0, you are estimating that I will be able to complete my project by 30th September, and therefore entire 20 lakhs will come and sit as a revenue. So therefore 100 plus 20. 100 plus 20 multiplied by what is the percentage? 60% complete. 72 lakhs. 72 lakhs. Okay. So this would be the revenue that you would recognize. Acha, previously, before factoring this bonus, they would have taken the revenue at 60 lakhs. Okay, they would have taken it at 60 lakhs. So you will be doing a catch-up adjustment. How they would have taken 60 lakhs? 10 lakh into 60%. Yes, are we okay with this? All right. Kriti, did you follow? Tanisha, Mansha, did you follow? Okay. Sir, in this question, estimation of the amount of variable consideration bonus is based on likely outcome method. That's right. That is how they have done it. Is it clear, everyone? Yeah? Bolo. Okay, fine. Coming next. So this concludes illustration 57 also. Okay. An entity enters into a contract with a customer for two intellectual property licenses A and B, which the entity determines to represent two performance obligation each satisfied at a point in time. The standalone selling prices of licenses A and B are 16 lakhs and 20 lakhs respectively. The entity transfers B at inception of the contract and transfers A 1 month later. Okay. Case A. The price stated in the contract for license A is a fixed amount of 16 lakhs. For license B, the consideration is 3% of the customer's future sales of X. Future sale of products that use license B. For purposes of allocation, entity estimates its sales-based royalties to be rupees 20 lakhs. Allocate the transaction price. Case B, Alternative, the price stated in the contract for license A is a fixed amount amounting to rupees 6 lakhs. And for 6B, okay. For license B, the consideration is 5% of the customer's future sale of products that use license B. The entity's estimate of sales-based royalties is rupees 30 lakhs. Entity is transferred, license A is transferred 3 months later. Royalty due from the customer's first month of sale is 4 lakhs. Allocate the transaction price and determine the revenue to be recognized for each license and the contract liability, if any. Is it okay? Yes. So let us proceed to start this. Do I have a variable consideration here? Yes. Right. Do I have a variable consideration here? Answer is yes. If you look at entities, one of the license, that is license B, the consideration is 3% of the future sales. So how will I come to know that the consideration I am paying, that the sales I will earn in the future, I will take 3% of that? How can I do that? How can I do that? Yes or no? Are we able to follow? Because the consideration will be determined only at the end of the year when the actual royalty is becoming due for your payment. And therefore, variable consideration allocated entirely to one performance obligation, 16 lakhs for A, and for license B, the consideration is 3% of the customer's future sales of products that use license B. Are we okay with this? Yes. Yes. So the problem is license B, the consideration is dependent on future sales. So therefore, I cannot do any specific allocation. I cannot do any specific allocation. Are we okay with this? Yes. Okay. So therefore, you allocate 16 lakhs to A and 20 lakh on a variable basis to B. They have not given anything there. So answer is fairly simple. 16 lakhs A, overall 20 lakhs to B. Are we okay with this? Yes. Are we okay? Any doubts? No doubts. So that's it. Okay, fine. Let us then proceed. Okay. The price. So in case one, this is illustration 56. Case 1, 16 lakhs. License B, you can allocate 20 lakhs, but there is an allocation of transaction price which depicts the consideration an entity expects to receive, that is the standalone prices. This you will recognize immediately when control is transferred. This one you will not recognize it immediately at the end of the what you can say. You can recognize this at the end. of the year when your royalty amount gets known to you. Okay, when your royalty gets known to you. Okay, so this one will be when subsequent sales happens. When subsequent sale happens. Are we okay with this? Yes. Coming to the next case. The price stated in the contract for license A is a fixed amount, that is 6 lakh rupees. Okay. And for license B, the consideration is 5% of the customer's future sales and product. Okay. So we will have to proceed with the allocation of the transaction price. Any ideas for case B, anybody? Yeah, just read case B. No suggestions? Case B. The price stated in the contract for license A is a fixed amount of 6 lakhs. For license B, it is 5% of the customer's future sale of products. Entity's estimate of the sales based royalties is 30 lakhs. License A is transferred 3 months later. The royalty due from customer's first month of sale is 4 lakhs. So therefore allocate the transaction price. Yes. See, if you have a plain reading, license A appears to be 6 lakhs. License A appears to be 6 lakhs and license B appears to be 30 lakhs. If you look at it immediately, okay? If you look at it immediately, estimate is 30 and here it is fixed at 6 lakhs. However, there is an issue. There is an issue with this because it does not depict the standalone prices. It does not depict the standalone prices. What is my standalone prices? What is my standalone price? My standalone price is 16 lakhs for A and 20 lakhs for B. वो कहाँ से मिला? That has come in the previous one. Standalone selling prices of A and B are 16 lakhs and 20 lakhs respectively. So allocating 3 lakhs to A and 30 lakhs to B, or 6 lakhs to A and 30 lakhs to B, is actually not correct because it does not depict the standalone selling price. Therefore, let me now do the allocation of the selling price. Case 2. Okay. License A. 6 lakhs into 16 lakhs by 36 lakhs. What is this 36? It is nothing but this 16 plus 20. Okay. Six into 16 by 36. 2,66,667. License B. 6 lakhs into 20 by 36. 3,33,333. Done? Are we okay with this? Anybody has any doubts so far? And then allocate royalty also to A and B. Allocate royalty in the ratio of 16 is to 20. 16 into 20. So if 4 lakhs was your first royalty, then 4 lakhs into 16 by 36, 4 lakhs into 20 by 36. So that is going to be our allocation of royalty as well. Done? Have you guys understood? Yes. Satish, Shruti, Viraj, Shankar, Mohammed, did you guys understand? Okay, because now we are coming to the last step, that is recognition of revenue. Okay, there is one big, not big question, but one big question from the study module, which I said I will do it today. Okay, all right. Coming to the last step, recognize revenue as and when performance obligations are fulfilled. Continue to recognize the revenue as and when performance obligations get fulfilled. Okay. So now we will just have a look at one of that question first, and then we shall look at the other questions. Then we shall look at the other questions. Okay. So coming back to that question, it is illustration number 32. Yes. An entity has a fixed fee contract for 1 million, that is 10 lakhs, to develop a product that meets specified performance criteria. Estimated cost. Okay. Can you please repeat case 2 license B? Okay. See, license B, my total consideration which I have received is 6 lakhs for license A and the royalty based turnover. Okay, one second. Let me just open that. Question. Just a minute. Yeah. Okay. The price stated in the contract for A is 6 lakhs and for license B the consideration is 5% of the future sales. Entity's estimate of sales based royalties is 30 lakhs. Here license A is transferred 3 months later. Royalty dues from the customer's first month of sale is rupees 4 lakhs. Okay. So now the question is, can you please repeat this one? So first thing, you could directly allocate 6 lakh to license A and your estimate of 30 lakhs to license B. But the problem is if I do this, they will not depict the true picture. They will not depict the true picture. It would be uh, what you can say, we do not have any justification to say that it equals to the standalone prices. Okay, so therefore we do the allocation. Now, how am I going to do the allocation? Well, the allocation is based at a price of 6 lakhs. So I will first divide 6 lakhs in the ratio of the standalone prices 16 and 20, which is given at the beginning of the question. Next, the remaining amount, okay, after allocating 6 lakhs, yes, on a straight line basis for A, we will do the same thing for B as well. We will do the same thing for B as well. So, okay. Now, as and when I collect 5% of sales as my royalty revenue, as and when I collect 5% of my sale as royalty revenue, what am I going to do is that also I will apportion it between A and B in the ratio of standalone selling prices. Okay, so that is what you will be doing. That is how the allocations will happen for the case B. Okay, yeah. Okay. Is it okay, Mohammed? Yeah. All right. Coming next, estimated cost to complete the contract is 9,50,000. Entity will transfer the control over 5 years, uses cost to cost input method to measure progress on the contract. An incentive award is available if the product meets the following weight criteria. 951 or greater, weight is 701 to 950, 10%, 700 or less, 25%. Okay. Okay. The entity has extensive experience creating products that meet the specific performance criteria. Based on its experience, entity has identified five engineering alternatives that will achieve the 10% initiative and two that will achieve the 25% initiative. In this case, the entity determined that it has 95% confidence it will achieve the 10% incentive in Bharat and will achieve the 10% incentive and 20% confidence that it will achieve the 25% incentive. Based on this analysis, the entity believes 10% to be the most likely amount when estimating the transaction price. Therefore, the entity include only the GST percent award in the transaction price. Therefore, entity includes only the 10% award in the case of transaction price where revenue below the where entity because entity has concluded it is probable that a significant reversal will not occur when the uncertainty associated is subsequently resolved due to 95% confidence in achieving the 10% award. The entity reassesses, all of this is verbose, you can skip it. Entity reassesses its product status quarterly to determine whether it is on track to meet the criteria for the incentive award. At the end of year 4, it becomes apparent that this contract will fully achieve the weight-based criteria. Therefore, the entity revises its estimate of variable consideration. Revises its estimate to include entire 25% incentive fee in the last year 4 because at this point it is probable that a significant reversal will not occur. Evaluate the impact of changes in variable consideration when cost incurred is as follows. Okay, they have given you the cost incurrence. They have given you the cost incurrence. Now, have you read this question? What is your fixed consideration? What is your variable consideration? Can you please tell me? Yes. See, these are the estimated cost to complete the contract. You have this variable consideration. Okay. And a contract for 1 million. Fixed. Fixed. Yes. So therefore, this is illustration 32, I think. Yeah. Okay. So now fixed variable. Okay. Incentive. Now, how am I going to do this? First one, cost, cost completion. Cost incurred. Fifty, 1,75,000, 4,00,000, 275, 50. 50,000. Done. So my cumulative cost will be 2. Okay. So this is your cost and stage of completion. 5 divided by 9.5. 5.26%. Two point two five 2.68. Okay, so this is your stage of completion. All right, and now this we shall apply for revenue recognition. Revenue recognition. So 11 lakhs was my initial estimate of revenue. Am I right? Because 10 lakh was the fixed price and yes, in month 4, we are having more clarity and entity revises its estimate to include the entire 25% incentive fee. So therefore, plus plus 1 lakh 50 more variable consideration into 94.74. And last one is 200%. So this gives you 23. Revenue to be booked. First month 57,860. Second month will be 259,600 minus. So 201. Minus 57,860. 202,620. Rule 5. Mhm. Are we clear with this? Yes. Are we clear with this revenue working? Okay. Twelve crore 50 lakhs. Are we clear with this? Yes. The total revenue that the entity will be recognizing is going to be 12.5 crore, depending on the estimation of the work completed. In between, the variable consideration has enhanced because now they believe that the project will get over earlier than expected. So they will be entitled for the second tranche of the variable consideration. And therefore, that is added in the fourth in the fourth row. What is important is the addition of 1,50,000 in number 4 to the revenue cannot be regarded as a prior period item or a change in accounting estimate or a change in accounting policy. It is merely a change in estimate. It is merely a change in estimate. And therefore, you are going to take it prospectively only. You are going to take it prospectively only. Are we able to understand? Yes. Are we able to follow? Any doubts? Satish, Mohammed, Tanisha, Mansha, Viraj, Shankar. Okay. Anybody has any doubts? All clear? No revert. Okay. Now, this is the way we have presented the answer. Institute has taken a different manner of presentation. Okay. What Institute has done is it has split the fixed consideration and variable consideration. It has splitted that up, okay, because data is already available. And then it has done the allocation of fixed revenue and allocation of variable revenue. Okay, so this is what has been taken up now. This is what has been taken up, shown separately in this presentation. Apart from that, everything is more or less the same, and therefore, this is your institute solution. You want, you may follow this. You want, you may do the way we did. The way we did saves a lot of time because so many columns are not going to be yeah, you will not be needing so many columns and rows for your answer. It's just a 4 5 line answer which we saw. So that presentation also is perfectly fine. Okay. So that's your choice. You can go through this. It's exactly the same what we have done. Okay. All right. So that takes care of this part. And finally, mm, 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 mm. All right. Okay. So that takes care of that question. Coming next, warranties and all we have done. There is nothing much I need to do. Okay. Mm, yes. So we have all seen this revenue recognized at a point in time, revenue recognized over time. We have seen this in detail. We have also seen the cases where you recognize the revenue as and when the product benefits are getting transferred to the uh, mm, okay, yeah, all of this is done. Yeah. Yes. We saw input method, output method, measuring progress on a straight line basis. All of this is what we have already done that time. So nothing much to take you through. Okay, coming next to some quick concepts. I think, did I take repurchase contracts with you? Did I take repurchase contract and incremental cost, all these terms? Did I take it with you? Yes. I remember that highway and toll project. Did I do that with you? Highway and toll, Nagpur, Bhilwara. Yes. Kolhapur highway. That one question is there in our study material. I think, did we do it or did we not do it? Yes. Okay. Let's proceed anyways. So now coming to our question, coming to sale and repurchase agreement. This is all part of step number 5 only. Okay. Sale and repurchase agreement. A sells goods to B at 100 and agrees to buy it at 110. Okay. Now, A has entered into a contract to sell goods to B for 100, and after 1 year, he will buy back the goods for 110. So here, it looks something fishy, right? It's not actually just a sale and repurchase. What exactly it is this is a financial liability. This is a financial liability. All right. What do you mean by financial liability? It means that you will be treating it as a loan financing arrangement. You will be treating it as a financing arrangement. Okay, so 100 rupee loan is given. Against that, a security has come, and end of the year security is released and the money is received back. So that is exactly what do you mean by sale and repurchase contract. Okay. Coming next, sale and repurchase opposite भी हो सकता है. A has a TV, sells it to B for 100. B returns back the TV for rupees 90. B returns back the TVs for B sells it back to A for 90. Tell me anything odd in this particular transaction and what it is. Yes? Can this be a genuine sale and purchase transaction? Answer is no. What A has done is A has given the asset to B. B has paid him 100. After 1 year, A will return back 90, keep 10 to himself once he gets the television, once he gets the product back. Okay. So therefore, A has given to B the right to use that asset, and after 1 year it is going to get the money back. In this case, 10 rupees is interest element. In this case, 10 rupees is not interest. In this case, 10 rupees is lease expense. Lease expense, and 90 rupees is security deposit. 90 rupees is security deposit. So therefore, when I talk about Give me a minute. Give me a minute. Take the battery. Funny actually, the first time battery drained so fast. I was not expecting. Okay. All right. So in this case, 10 rupees will be your lease expense and 90 rupees would be the security deposit that is being returned back. So this is the case where you sell and buy back at a lower amount. So this is classic sale and repurchase contract. In the first case, you sell and you buy back at a higher amount, means it is a financing arrangement for you. You are bearing the interest. In the second case, you have given the asset on use to the other party, and the other party is you are buying it back from him. So therefore, ultimately, it could be a lease expense with a security deposit arrangement. So under the sale and repurchase category, we have something known as call options and put options. Have you heard call options and put options? Yes. Yeah. Have you heard call options and put something is wrong? Okay. Have you heard call options and put options? Yeah. So this is something of that sort. This is something of that sort. Okay, just give me a minute. A line researches. Okay. Okay. So now when A sells to B and buys back, A is the one who is having a call option. Call means right to buy back the asset. So if 100 at 110, it is a financing arrangement. You are in the books of A. You are in the books of A. That means you know for certain that you are buying or you are going to exercise this option back. And therefore, at the inception of the contract itself, what are you going to do? You will record it as a financing arrangement. Same holds true if instead of 110, you take it at 90, you will record it as a lease and close the matter because you are in the books of A. But suppose A sells to B and A does not have a call option, but B has a put option. B has a put option. Are you able to understand the difference? Yes. Are you able to understand the difference? In the first case, you were in the books of A. You were in the books of A. You knew exactly how to do the accounting. You knew exactly how to do the accounting. In the third case, what we are seeing now, I am in the books of A only, but it is the counterparty that has a put option. I do not have a call option. What is the difference between both of them? In the second case, it is at the option of the counterparty to sell. If he exercises the put option, I will have to definitely honor that. I will have to honor that. But suppose he did not exercise only, then what are you going to do? So that is why what the standard tells is call option, you have to reverse the revenue mandatorily and show the substance of the transaction. That is financing or lease arrangement. But in the case of put option, the ball is in the counterparty's court. So therefore, I cannot make any decision really. However, you look at the benefits that are accruing, and if the benefits are at market rate or above that, then you can assume that the option will be likely exercised and you go ahead and record the transaction as per its substance. Are we okay with this? Yes, are we okay? Any doubts? Any doubts? So what you will have to see is significant economic incentive to exercise. Significant economic incentive to exercise. If yes, account as financial liability or lease. Account as financial liability or lease. Are we clear with this? Yes. Are we clear? This is only in the case of put option. Call option, I know what I'm going to do. So therefore, उसमें कोई option ही नहीं है. Okay, right to sell. Are we okay with this? Yes. Put option to B. Okay. Yes. Shruti, did you follow? Mohammed, did you guys follow? Yes. All right. Tanisha is not there. Okay, fine. Let us see. No problem. Coming next, we had done. Okay, so now coming to the last closing parts, we had done appendix to Ind AS 115, service concession arrangements. Do you guys recollect this? Do you recollect this? Service concession arrangements. Example, toll road, airport, ports, etc., which is basically public-private partnership, Okay, so we have two models. An entity constructs a road. On that road, it can collect a toll. On that road, it can collect some toll. Okay. So in this case, the government gives assurance. That if the road is not picking up so well, that means the public are not using the road frequently, then I will guarantee you with the cash that you expect at the time of construction of the road. Okay, so what was your expectation that time? That much I am going to pay you. So you as the entity are having two things. Either public will come and pay you cash, or government will come and pay you cash if public does not come. In other words, whoever comes, they will pay you cash. In other words, it is nothing but an unconditional right to receive cash. In other words, if this is the arrangement, it becomes financial asset. It becomes a financial asset. On the other hand, there is no unconditional right to receive fixed amount of cash. Government बोलेगा, I'm not giving you any guarantee. Yes, but yes, you have a right to a future economic benefit. You have right to a future economic benefit, okay, which is not fixed cash. Then the contract will become an intangible asset because it becomes an intangible asset because there is no unconditional right to receive cash. It was there for the government assurance model, but this is not a government assurance model. So therefore, this becomes an intangible asset. Sir, why an intangible asset? You have a right to economic benefit, but you cannot, you do not, that asset does not have any physical substance. Neither is it separately identifiable, nor is it non-monetary in nature. Yes, are we okay with this? These are the two models. We'll just have a look at the question on this. Yes, I think I had done with you because I have marked it. It means I would have done with you. But nonetheless, let us run through this question. Please tell me if we have done this. Please tell me if we had done this question. Okay, we had done this. Good. So we saw both the options. We saw both the options by treating it as a financial asset. Yes, that's right. Okay, all right. We saw it as a intangible asset also. Okay, fine. So if it is last minute, I will run it properly so that you can understand better. Okay. So there is this construction contract which is awarded to ABC Infrastructure Limited. As per the contract, there was the construction cost is 3,000 crores with a margin on construction expected at 10%. So the standalone price is 3,300. 3,000 plus 300. The period of construction is 3 years. Okay. Obligation to, after you construct, you will have to maintain that particular infrastructure which you have constructed. Operating cost per year is 40 crores. Expected margin on operations is 25. So the standalone selling price is 50. Revenue by government at the end of the 10th year is 5,900 crores. Both are distinct obligations satisfied. First one over 3 years, second one over 7 years. So satisfied over a period of time. So this is the facts of the question. Yes. Now, okay. Is there a contract? Answer is yes. Are there distinct obligations? Answer is yes. Step number 3, is there a transaction price? Answer is yes. Government revenue at the end of the 10th year, 5,900 crores. Step number 4, allocating the transaction price based on cost plus expected margins. That is standalone selling price. And step 5, recognize revenue by measuring progress taking. Example, cost method. By progress. Example, cost method. Okay. So now let us start. Now let us start. Okay. Cost incurrence, year 1, 800, year 2, 1200, year 3, 1000. Okay. So now let us come to the question. Okay. Hmm. Just give me a minute. I'm just trying to check. Yes, what is the flow? Okay. Okay. So year 1, I will do a construction of rupees 800 crores. So therefore, 800 plus 800 crores. So construction account debit to bank, that will be 800 crores. Now, the moment you did this, you will have to book the revenue. Revenue will be with a 10% markup. So therefore, financial asset account debit 880 to construction revenue account, So therefore, 880 will go and sit as an addition in your IRR working. Okay. So 880. Next, construction cost is 1200. Margin is 10%. So 1200 plus 10% plus 10%. So that gives you 1320. That gives you 1320. This is my revenue which I'm booking in the second year, and that also goes and sits as part of your working. Your 6.57% is a calculated rate of return, which is basically equating the revenues that you are generating with the final payout that the government is giving you of 5,900 crores. So this is your IRR. This is your IRR. It is equating your outflows with the inflows. It is equating your outflows with the inflows. So therefore, 6.57% is your IRR. Okay. All right. Now, the next step is 1320. Thereafter, eh, year 2, 1200. Okay. All right. Fine. So then you start to amortize this. You then start to amortize it as your finance income, as your finance revenue. Okay. So this is the amortized cost method which you have studied in your financial instruments. Okay. So 57.82, 148, 230, etc. These are your okay. Coming to the third year, 1,000 rupees construction, 1100 the revenue, which will go there to the IRR table. Then 148.34 is the interest that you will recognize. Coming to year 4 onwards, yes, you will only have operations. 40 out of that, 50 is what you will take to revenue. So that 10 will again go and sit in your financial asset. Next, you will recognize the revenue, so on and so forth. Okay, so in each of the years, you will have the cost incurred. After the cost incurred, you are going to have the after the cost incurred, you are going to have the revenue after the markup, and after that, you will then be having the related finance cost. The related finance cost. Is it okay, everyone? Yes. So far, have you understood? Yeah. Any doubts so far? Shruti, Yadu, anybody has any doubts so far? Yes. Any doubts so far? No doubts. Clear. Okay, fine. So each year you will do these three things. Cost, record the revenue. Revenue impact you will take to financial asset because you are guaranteed a revenue from the government. Equate the guarantee with the revenue that you book. So that gap will become your IRR. That gap will become your IRR. Okay. So that takes care of okay, that takes care of this part. That means we have reached up till the end of the last year. In the last year, what will happen? In the last year, I will fulfill my operating cost. That means my operations obligation. So I will do that. Then you are going to take your uh, those incomes, whatever are there, you would have taken them to the asset account. You would have booked the interest cost for the last year, and finally whatever is left would be nothing but the finally after bringing in the government money and the financial revenue for the last year, your account should match, the financial asset account should become nil. It should become nil. Okay. So that takes care of your financial asset becoming nil. So accrue the asset, accrue the finance cost, the finance income, take them to the P&L on a daily basis. At the end of the contract tenure, you will get the money, number one, and your financial asset ends up becoming zero. So this is what you will do basically. Okay. Coming to the next one, coming to the next question. Okay. Coming to the next one, this is also treating it as a financial asset. But here, I don't think there is any revenue. I don't think there is any revenue implication. Okay. What is there is a right to collect the toll, and receipt of toll is your consideration for operations. The right to collect the toll is consideration for construction. The receipt of toll is considered for operations. Is considered operations. Is it okay? So basis that this question has been done, where construction period, all is the same. There is no change. Both are distinct obligations. So you are going to pass the entry accordingly. Construction cost account debit to bank 800. Intangible asset account debit to construction revenue account. Okay, intangible asset account debit to construction revenue. Construction cost P&L debit to. Okay, so year 2 also the same, year 3 also the same. Year 3 also the same. Okay. So that takes care of this. In the end, what you will do is you will recognize the total income and amortize the entire intangible asset account. Amortize the entire uh, intangible asset account. Okay, so this is what you will be doing. This is what you will be looking at. All right. So that takes care of service concession arrangements. Please go through this once. They are not very difficult. They are also quite simple only. Okay. Yes. All right. I have a question. Sir, say a contract for 200 hours per month at 250 per hour. Traveling expenses is, let us say, 5,000. Revenue is 200 hours, 50,000. Traveling expenses recovered from the client, 5,000 actuals. Traveling expenses recovery should be adjusted against. Okay. So, received actuals, traveling expenses recovery should be adjusted against such gains or no? Okay. So basically, both are two different things. You would have spent money on your travel, which you are claiming as a reimbursement from the other side. You cannot basically, go and say that I will net off my income against my expense and give a net figure. That we cannot do. So therefore, you will have to show them separately. You will have to show them separately. No netting would be permitted. No netting would be permitted. Okay. So this takes care of service concession. Now, what I want you guys to do is, first of all, those homework questions, whatever are there. Second, there are some good questions in RTP and questions what are there. There are some very good questions in your question papers as well as your RTP, MTP. So my advice is please go through them before so that you can get more confidence. And lastly, what you will have to check is you will have to just go through one thing, that is IP rights. Okay, very small concept, hardly anything is there in that. It may not even be one proper page from the institute's study material perspective. Okay. So it's very, very manageable. So please go through that. Yes, bill and hold we had done. Licenses of intellectual property. Just go through. Yes, licenses of intellectual property, go through for homework. And that's it. That's the only thing which is left. Okay. Rest, contract cost you can read through. This had come as a direct question in the last attempt. What do you mean by contract cost? Basically, contract cost is of two types: costs for acquiring a contract, cost for fulfilling a contract. Cost for acquiring a contract represents incremental cost incurred, like sales commission, etc. Okay. So these costs you will pay only if you get the contract, only if you get the contract. So these items we should be recognizing it as an asset. Uh, the incremental cost to obtain a contract. So it recognizes an asset means a asset against which revenue will be adjusted and it will be knocked off. Okay, so this is contract acquisition. Contract fulfillment, cost to fulfill. So this is a cost to fulfill a contract only if not covered in scope of other not covered in scope of another standard. Recognized as an asset if costs relate to a contract or anticipated contract. Generate or enhance resources that will be used to satisfy performance obligation in the future and expect to be recovered. So these are just some small go through areas for you. Okay, just go through this. It's mostly theory. Nothing is there. So that takes care of this. Okay. Try to solve those questions. Today we did quite a number of questions. Kind of refreshed Ind AS 115 for you guys, I hope. Yes. Was it helpful to you? Yeah, everyone? Was it helpful? I hope it was helpful. Whatever we did today, it kind of refreshed your memories, and also we could touch upon some questions which we had been unable to do the last time. We saw significant financing component. We saw what else did we see today? We saw service concession arrangements, then we saw non-cash consideration, allocation of revenue, we saw in detail. We did certain questions also. So then we did sale and repurchase. So we have done some major parts. I did not run you through the first one. I did not run you through the first part, that is step number one and two much, because they are largely theoretical in nature, not much of questions I anticipate. So I did not run you through that. But yes, I ran you through the later parts. That also selectively what was not solved much in the last sessions, we could do that. Okay. All right. Now, coming to the next one. Okay. FR, how do we approach the examination? Okay, let me be very clear. Your FR is going to be your first paper. Okay, your financial reporting is going to be the first paper. And no matter whatever you say, the first paper, if it goes excellent, बात ही कुछ और है, right? You get a renewed sense of confidence to approach the remaining three papers or six papers, as the case may be. Remaining two if you're answering one group, or remaining five if you're answering both the groups, right? And suppose that is how the new syllabus is. So all of you must target your financial reporting paper in particular to score exceedingly well, to score exceedingly well. Okay. Practice is the key. You have to practice. You need to ensure that you take care of your study material, no doubt. Study material is extremely exhaustive. Okay. But from an exam focused approach, I believe your MTPs and RTPs and past papers should do the trick. Because what happens is, in the study material, they put a lot of illustrations, they put a lot of questions which are more theoretical in nature, because they want you to understand the standard. Like today we saw Ind AS 115. Many questions are just paragraph answers. Those questions you will not get in the examination. You will be getting questions which are related to problem solving. So that is why my suggestion is, go ahead and review all the RTPs that are there. Okay. You would find that very much helpful for the purposes of your exam. Okay. So that is a key thing which you will have to look into. Coming to the other aspect, try to solve some papers before you go to the exam. Never solve a question paper first time in the exam hall. It was a mistake which I had done. I will not suggest that to anybody else. Okay. You will have to ensure that you solve at least three papers before you go into the exam hall. Speed is key. You need to ensure you are fast in doing, so that you can attempt the question paper entirely. Otherwise, it becomes difficult to score. If you come saying that I attempted only 70 or 75 marks, that is very difficult. Okay, I will not say it's a very ideal situation unless you are absolutely sure about what you want to score, about what you have attempted. You should be absolutely sure. Okay, so therefore, this takes care of your papers. Ensure that you revise the study material, RTP, MTP, these two have to go. And along with that, if you can review some past exam papers, I'm sure it will be of great help to you. Okay. Uh, yeah. Anyways, more of it we can come around later because we still have a couple of sessions, right? So I think mine will be the last session on financial reporting. I don't see any further sessions planned. Yeah. Because analysis normally Ind AS 101 is what we take towards the end, because by then you would be knowing all the standards. So at that point of time, it becomes easy to explain to you multiple things. Yes, I think this is the last one. Yeah. Yeah. So, all right. So that's it for today then from my side. Yeah. Thank you. Take care. See you guys on Tuesday and Thursday, Saturday and Sunday. And I think we have a session on Wednesday also. So see you guys on these days. Yes. Thank you very much for a patient hearing. It's been extremely difficult, I suppose, so many subjects to study at one time, but we've all been there, done that. So that should not be a problem for all of you. Okay. Yeah. All right. Take care. See you guys on Tuesday. Okay. Now, before we come on Tuesday, yeah, Tuesday is Ind AS 101. Before we come on Tuesday, I want you to quickly brush up. You have recently done financial instruments. You have recently done 103, but it has been ages since you did Ind AS 102. It has been ages since you did which are those standards? Asset-based standards. It has been ages since you did your business combination also. I will say it has been centuries since you did, because financial instrument only will take multiple weeks for you to finish. So if possible, just brush up the key pointers of these standards, because in Ind AS 101, we are going to look at all of these from a transitionary perspective. So, till now, you know the concepts, but now I need you to know two things. One is, what was the treatment under accounting standard? What is the treatment under Ind AS? How do I transit into Ind AS? So that exactly is what 101 talks about. So please ensure that you are ready with this particular what you can say requirements. Okay, just brush up. I don't need you to pour over FR entirely. Okay, so then we can be a little fast with those standards. Okay, so thanks everyone. See you guys on Tuesday for Ind AS 101. I hope it's 101, right? We have three classes on Ind AS 101. Yes. Yes, we have three sessions. Okay. So see you guys accordingly. Thanks. Thank you. Yeah. Okay. Session done. Thank you.